All right, we are on learning objective 6.2. We are preparing the statement of cash flows with the indirect method. Okay, we're not going to do the direct method. Before I dive in to all of this information, I want to draw you out a T account. Here is that one rule that I told you you're not going to have to memorize a whole bunch of rules. There is a whole bunch of rules to memorize later on in this chapter. They'll give them all to you. I don't want you to memorize rules. I want you to understand what is actually going on. Okay. And this was taught to me when I was in college. It is a very good universal rule to help you do statement of cash flows. Okay. If you don't want to learn one rule and you want to memorize all the other ones, that's fine with me. Okay. But if you're getting it wrong, memorizing all those rules, then what am I going to tell you to do? Go back and use my rule. Okay. So this works for any account. It does not matter what type of account it is. Okay. A long time ago, before it was called a statement of cash flows, it was actually called a use and source statement. When I was a bookkeeper, our owner actually asked me to do a use and source statement, and I just was like deer in the headlights, like I have no idea what you're talking about. So, and he was like, it's got cash flows and blah, blah, blah. And I was like, oh, we call that a statement of cash flows now. So it used to be called a use and source statement, but that's going to help you memorize use and source. We live in the US here. Okay. So this is the use, and then the source is over here. Okay. This works every time. When I first started teaching this, I had a student whose mom had a PhD in accounting, and they tried their very best to prove this wrong, and they never could. Okay. Because it was a PhD that taught it to me. Okay. So, any account, if there is a change on the debit side, it will always be a use and it will always be subtracted. Okay. If the change is on the credit side, then it is a source of cash. It will always be added. Okay. So as we go through this, I'm going to draw some of these T accounts out and show you how that one rule will work. Okay. What are the things you're going to need? You are going to need the income statement for the current year, balance sheet from the current year, and the prior year. Should be some additional information based on review of the transactions. Okay. I'm not going to go through that 5 steps. Okay. So right here, we have a comparative balance sheet. This is great. This gives us a comparison between ending, realize your ending is 24, and the beginning, I'm sorry, I did that wrong. The 2024 is the beginning. It's last year's ending, but it's this year's beginning. Okay. And then that is ending. Okay. When we do a statement of cash flows, when we actually see it and we start putting it all together, you always have a built-in check figure at the end of it, is the change in cash. Right here, it looks like cash decreased by 20,000. That should be at the very bottom of your statement of cash flows. Okay. All three of those sections, operating, investing, and financing, will all equal negative 20,000. Okay. So let me see here what they've got. There's our income statement. Okay. The thing we need off of there is our net income. We also need this depreciation expense. I didn't see anything else. Oh, there is this gain on disposal of plant assets. We would need that as well. I didn't mention that earlier, but we'll take that into consideration as well. Okay. We have this comparative balance sheet. We don't do anything with the cash because that's the whole statement. Okay. That's the entire statement that we're looking at. Okay. And let's see what else they give us. Oh, they just did the whole statement of cash flows for us. Okay. So they just gave it all to us. I wish they'd kind of baby stepped us through it. Okay. The first thing that will always be on the statement of cash flows in the operating section is net income. So when you're working this problem, forget all of this detail right here. Draw yourself out. You're operating, leave yourself lots of room for operating because there's lots of transactions that actually take place in operating. Okay. Investing and then financing. You don't have to have as much room for those two because there's usually not that many transactions in there. Remember what I said, how you have a built-in check figure? Look right down here. If you don't know anything about statement of cash flows, you could get these three lines correct. Okay. You have your cash balance ending 22,000. You have your beginning. We know that the change is going to be a negative 20,000 because that's what our balance sheet told us. Okay. So those three numbers have to equal that negative 20,000. Okay. So, oh, sorry about that. Get that back over there in line. Okay. So the first thing we're going to do is we're going to look at this accounts receivable right here. Okay. I'm going to draw this T account out for accounts receivable. Okay. Our beginning balance in accounts receivable was 73,000. Our ending is 90,000. Yes, I already had the math done there for me, but it's easier to see in this T account because of my one rule, remember? Okay. So it looks like accounts receivable increased from 73,000 to 90. So the change was here on the debit side of that T account. What did I tell you on that one rule? If the change is on the debit side, you're going to subtract it on the statement of cash flows. If it's over here, we would add it. Okay. Now let's just think through this. Okay. Net income is in that operating number. Okay. We had $17,000 of sales on credit that went to accounts receivable. Those sales are in the net income, but that 17,000 is not in cash. Okay. So we've got to subtract that out to get our cash from operating activities. Okay. So we're going to come down here. I guarantee it's going to say something like subtract. Well, they didn't say subtract. They've got an increase in accounts receivable, but they do have it a minus there. Okay. In front of that 17,000. Okay. We are adding the depreciation expense. Remember the journal entry we made for depreciation expense? We would debit depreciation expense. We didn't credit cash, did we? No, we credited that account called accumulated depreciation. So depreciation, depletion, and amortization always get added back because they are a non-cash expense. Okay? They are non-cash expense. Okay? So now let's look at the next thing that we have. They give us merchandise inventory. Okay. Merchandise inventory. I'm going to draw that T account out again. Merchandise inventory started with 145 and it ended with 143. Okay. And there was a change of 2,000 on the credit side. Okay. We know from my one rule that we are going to add this. Okay. Why are we going to do that? Let's kind of conceptually think about it. We sold $2,000 more of inventory than what we purchased. Okay. So that 2,000 represents the cash we did not have to put out, but we had cost of goods sold. That 2,000 is included in that cost of goods sold, which is included in net income. Okay. So we will add the decrease in merchandise inventory. Okay. I'm really not following along with the statement of cash flows. I'm trying to follow along this information that they're giving us on the balance sheet or the comparative balance sheet. Okay. Then we have plant assets and accumulated depreciation. This will be the hardest part of the statement of cash flows. I know you're probably thinking, oh my goodness, this is just that other stuff was really hard, Miss Solano. I'm sorry. You only get better at it as you do practice. Okay. So plant assets started with 252,000. There's a lot of moving parts when it comes to the plant assets because you have these two companion, you have this companion account, accumulated depreciation. Okay. And it had an ending of 507. The depreciation, I'm sorry, accumulated depreciation started with, is that 42? And it ended with 47. Okay. Now we already know what depreciation expense was. Okay. That depreciation expense came from here, 20,000. Okay. So we know that this accumulated depreciation was credited for 20,000. Okay. So there's a lot of moving parts going here. I'm going to put in parentheses depreciation expense so you know where that number came from. If we bought any new plant assets, that would be debited. Okay. If we disposed of any, which we know we did because we had a gain over there, disposal would come from the cost would come out of plant assets, and then the accumulated depreciation associated with that disposal would be credited. Now, these aren't those two the same numbers. I'm thinking they're probably going to give us some more information about this. There's the depreciation. They're going through it step by step, but I'm attacking it a little bit differently. Okay. And they did not tell us. They didn't give us any detail on that. Okay. So I don't know why. So I'm guessing there's probably some information in the book that they would have given us on that. So there's our depreciation. We add that. And we're going to add the gain on disposal, but they didn't give us any other information. Okay. Sorry. I do apologize for moving this slides around so much. I am going to go look in the next section. I probably should have done that already. I'm sorry. And see if they tell us anything about no, that's long-term liabilities. Um, Here we go. So we have a partial statement here. We're showing that, oh, here we go. They got both of these T accounts out here for us. Okay. So I was going to do these two sections together. So I'm going to go ahead and come down here because I've already drawn that T account out. Okay. And we know that we had this depreciation expense. I filled that in. Okay. The disposal of there was an asset that was disposed of, and it had a cost of 55,000, and the accumulated depreciation associated with that was 15,000. Okay. So cost minus the accumulated depreciation of 15,000 gives us a book value of 40,000. Okay. So you can come down here and you can see that this journal entry is to get that plan asset off the books. They're trying to see how much cash did we get for that. But I feel like the gain up there said 20,000. No, it was 10,000. That was a depreciation expense. Yes. Okay. Just making sure those fit together. Okay. They told us there was a gain of 10,000. Okay. The only way we'd have a gain of 10,000 is if our proceeds from this sale, our proceeds had to be 50,000. Okay. So if we subtracted the book value of 40,000, we end up with a gain of 10,000. So we got $50,000 from the sale of this plant asset. Okay. So we can go back up here on that statement of cash flows, the whole one that they just showed us. Going up. There's the 50,000 right there. Okay. They had to give us this information somewhere else. They did not give it to us on the slide. I'm so sorry. I don't know why my slides keep bouncing like that. Okay. They had to give us more information to be able to back into that. So your problems as you're working these will probably give you a little bit more information. Okay. So since I'm going to go back down here to where that T account was for that, they didn't have to tell us that new plant assets was 310. They did have to tell us at least the 55,000. We could have backed into the 310 based on the beginning balance, ending balance, and how much was disposed of. Okay. So 310,000 was spent in investing activities. That was cash that went out to buy the new acquisition. So think about that. That's when the cash goes out. When we purchase a new plant asset, that's when the cash goes out. So here, the cash payment for the acquisition of plant assets, that's a negative 310. And we had gotten 50,000 from the disposal of the plant assets. So why do I have this $10,000 gain up here? Well, notice that the $10,000 gain and the $50,000 proceeds equals the book value of that asset. Okay. We subtract the gain because the gain was in that net income. We don't want it in that net income. Okay. That gain has to do with investing activities. So we are going to subtract that gain out of there. Now, I told you that's the hardest one. If you don't get that one, try to get everything else in your statement of cash flows correct. You'll know what what you got to total up to. So a lot of times when I was in college, I learned how to work these statement of cash flows backwards, probably better than I ever did forwards. Okay. Because you do have that built-in check figure. Okay. So what they had in the next objective is what I was trying to draw out right here for plan assets. And I was on my way, but they just didn't give us all the information that we needed. Okay. So that's the hardest right there. Okay. So cut yourself some break. Watch the video over again. Even if you're watching this doing the video quiz, you have access to go back and look at these videos in YouTube from the YouTube playlist. Okay. So we took care of all of these current assets. We took care of the long-term assets. We took care of everything in that section. Okay. So now we're going to do more. Okay. We're going to jump down to accounts payable. Accounts payable is a current liability. It will be operating. Okay. Remember, it has a credit balance and it has a beginning balance of 50,000 and an ending of 90,000. Okay. There is a change in this account of 40,000 on the credit side. We are going to add it. Okay. So if we come down here to the statement of cash flows, you will see that increase in accounts payable gets added right there. Okay. Clean this up a little bit because I know I've wrote all over it. I'll leave the operating, investing, and financing. Okay. So that's accounts payable. I am illustrating how this one rule can be applied to any one of these accounts. Okay. Then we have accrued liabilities. And the accrued liabilities started with 10,000 and it had an ending of 5,000. Okay. The change is on the debit side. Okay. Why is the change on the debit side? Because we paid off some of those liabilities and cash went out. Okay. So we will subtract that. Okay. We will subtract a decrease in accrued liabilities. So there they are right there. Subtract that 5,000. Okay. See, I'm getting it right every single time with my one little rule. Okay. So then we have the notes payable. Notes payable is long-term liability. That is going to be a financing activity. Okay. We have 80,000 as the beginning balance, and we are ending with 160,000. Okay. So it looks like we borrowed 80,000. They didn't give us a lot of detail on those investing and financing, so I am going to kind of jump back down here to see what, if they told us anything about that. Okay, we did that. So here's that additional information that I was looking for. Okay. Said they received $90,000 cash from the issuance of notes payable, and then they paid $10,000 cash to retire the notes. Okay. So there is a change of 80,000. I don't know if they're going to do that in one entry or two. Either way, it will still equal the 80,000. Okay. Let's see how they did it. Yeah, they separated it. So cash receipt of issuance of notes payable and then the cash payment of notes payable. Those two together equal the 80,000. Okay. The comparative balance sheet isn't down there in those slides. That's why I keep coming back up here to the comparative balance sheet. We need to go a little bit further. Okay. All right. We're almost to the end. And the great thing is we're doing two learning objectives, but I'm kind of doing them together at the same time. Okay. So now we're going to look at common stock. Let's look at that. Remember, that's also financing. Common stock had a beginning balance of 250,000. 250,000, and it had an ending of 370,000, which left us a change of 120,000. So, and that is on the credit side. Why would common stock go up? Because they issued more stock. They issued more stock and they got more cash. Okay. So that is in the financing section of the statement of cash flows. So you can see, where is it at? Cash receipt from issuance of common stock, 120. Okay. Then they give us retained earnings. Okay. There's some moving parts going on in retained earnings as well, but we've already talked about those. You've got retained earnings. You know that. Remember, retained earnings is got a, we hope it has a credit as a beginning balance. So I'm going to put that in. That beginning balance is 80,000. And the ending balance for retained earnings is 110,000. Okay. What goes into retained earnings? We know net income increases retained earnings, and we know dividends decrease retained earnings. Okay. We already know what net income is, right? We got that off of our income statement and it's already down there on our statement of cash flows. So our net income is 40,000. So we'll plug that into the credit side of retained earnings. But remember, we're not doing anything with it because we've already put that net income down there in the operating section of the balance sheet. I'm sorry, operating section of the statement of cash flows. Okay. So there's that 40. So I'm gonna come back up here. Net income was 40,000. Now we're going to back into what dividends are because everything else that left has to be dividends. So let me put it in my calculator. We should end up with 10,000 in dividends. Okay. We're not looking at the difference in these two balances. We're taking this net income because that has to do with operating. Okay. It's already in that part of the statement of cash flows. Dividends relate to common stock, and paying dividends is a financing activity. So you'll see right there the cash payment of dividends is 10,000. Okay. We have one more thing on that comparative balance sheet. One more thing, and I'm not going to draw a T account out because we can see treasury stock started at 0, ended with 20,000. Well, maybe I will go ahead and do the T account because I love to do T accounts. Treasury stock is that contra equity account. It started with 0 and then it is going to end with 20,000. So there had to be a $20,000 change on the debit side, so we are going to subtract it. Okay. So that is right there in treasury stock. That was actually a really large financing section. It had a lot more in it than I've ever seen in any other problem. Okay. So in this statement of cash flows, we totaled up those. Notice for operating, it said net cash provided because that's a positive number. But here they said net cash used because that's a negative number. And then they had net cash provided from financing activities. That was positive. Those three numbers added up together gives you the negative 20,000, which backs into your check figure from the beginning and ending balance in statement of cash flows. Okay. If you're totally lost right now, is okay. Probably I was just as lost as you are the first time I looked at a statement of cash flows. Okay. Um, One thing about statement of cash flows, while we've got this up in front of us, you can really see the life cycle of a business when you look at the statement of cash flows. So, for example, this business had some positive operating, it had negative investing activities, which is perfectly fine. If you're making a lot of money off of selling your long-term assets, you're probably on the verge of bankruptcy. Okay. So you really don't want to see a lot of positive cash flows in that investing section. Okay. So I would assume this is kind of a mid-life cycle of this business. They're not new. They're generating some cash and operating. They got rid of a piece of plant assets and they purchased another one, so they're sort of keeping up with things. Maybe it's on the newer end because they are generating more cash on financing activities. That's a positive number. Okay. So let's think about a brand new business. What would a brand new business look like? Okay. A brand new business would have probably a lot of negative operating activities. That would probably be a big negative number, huge negative number because you're buying a whole bunch of plant assets. There would be a negative number in investing. There would probably be a huge positive number because we're borrowing and issuing stock so that we can afford to buy all those long-term assets. Okay. So that'd be more of a brand new one. Let's think about a business that is probably on the verge of bankruptcy. Okay. It's going to have negative operating cash flows. It could have some positive here because we're selling off our plant assets to pay our short-term debt. Okay. We might have some positive or even negative here, depending on if they're really on the verge of bankruptcy. They're probably trying to pay some stuff off, so that may be negative. Okay. So the statement of cash flows gives you a ton of information. Like I said, if it was the only statement I could get my hands on, I would pick the statement of cash flows. So I'm going to kind of just go through these slides. We did all of those up there by that comparative balance sheet. Here's a nice little summary slide of all the different increases and decreases, okay? Just to kind of show you how my rule works. We had increases in current assets other than cash. We decreased them because if we had a current asset and it increased, it would increase on the debit side. So that fits my use and source rule, okay? Notice how it flips when we get to current liabilities because the debit and credit rules flip from assets to liabilities. So you can see, oh, that makes no sense. Here we're increasing an increase in current liabilities, but we're decreasing an increase up here. Remember, these are on two different sides of the accounting equation. Okay. All right. So we've kind of gone through all of these. I just want to make sure I covered everything in my going up and down on all of these. Okay. We had our long-term liabilities and we covered that. Here's RT accounts on common stock and treasury stock. If they give you a paid in capital account as well, you need to look at that together with the common stock account. Remember, you can have the common stock and then the paid in capital in excess of par. Okay, so that pretty much, they did the exact same thing I did in that T account up there for retained earnings. You have your beginning and your ending. We already had our net income, so it was real easy to back into our dividends. Okay, so that's how we computed the dividends. And we got the net change in cash. The first thing you're ever going to do when you're working a problem like this, grab that cash, go stick it down there in those last three lines. There's 3 points you get, and you may not even have a clue what you're doing. Okay, so grab that, do that first, and then you can see right here in a very summarized, here's our operating, investing, and financing. They all three equal the negative 20,000. Okay. So I kind of talked about non-cash investing and financing. So they could have acquired a $300,000 building by issuing stock, acquired $70,000 land by issuing notes payable, or retired $100,000 notes payable by issuing common stock. Those are all non-cash investing and financing activities. Okay. They're just giving you the entries because you can see how none of those involved cash. Okay. And that would just be listed as a note in the financial statements. Okay. It's not going to go into the calculation. All right. And we are done with statement of cash flows in chapter 16. I will see you in the next chapter.